Hey, welcome to the exchange. Let's talk about this real estate debt bubble, but not in the US, actually in China, going on right now. So the Chinese debt bubble is not a new thing. This has been known for a while, and this is articles from almost 2 years ago. And this is how long the story is. A roughly $52 trillion bubble we're seeing in China right now. Basically, this epic property booms the past 10 plus, 15 plus years, and it hasn't really slowed down that much until just recently, in the last 3, 4 months. So this is a chart right here in this article. It basically breaks down U.S. real estate, or actually U.S. versus Chinese real estate investment. And you can see in the U.S. Is the orange line, Chinese is the green line. I mean, China. I mean, it's been up and to the right for the past 15 plus years. With the U.S., we had the financial crisis, 2007, 2008 time frame. Obviously a downswing, but really since 2010 and beyond, it's been a straight upswing. We've seen that all across the nation, both urban and rural areas across the board. Scroll down here a little bit more, but so this is looking at Shanghai versus Shenzhen, which are basically two giant, large financial and tech hubs. Again, I mean, the property values, this is from 2012, 2020. I mean, almost 80, 90% plus. Shenzhen's 120% plus. I mean, just massive returns. So, I mean, your idea there is, hey, fear being missed out. Hey, I gotta buy now or buy, or maybe the price will get away from me. So it's one of those things where it's kind of like in the U.S. right now, where it's, hey, if I don't buy it right now, the price, even 3 months from now, it could be 100 grand more potentially, or 10% more potentially down the road. That's the fear. I mean, it's almost like this panic buying. If you bought in the last 15 years, I mean, you've done very, very, very well. But I mean, that might be changing now for the Chinese overall real estate markets, and we'll see what happens. So this is what I pulled from CNBC. This is a chart they have right here, basically looking at the total debt versus GDP. This is government and consumer debt, looking across the board, basically across China, Japan, U.S., and the European Union. If you see the very top right, or the very top part is Japan. Obviously, they have the most debt. They had the most debt for a while. They're in somewhat of a stagflation right now. They've been that way for decades. It's not anything new. But notice here, really, as the U.S. and the Europe are basically right now, their debt compared to GDP is actually pretty flat. So basically, as the U.S. and Europe has grown, debt's grown with it, but not accelerating faster than growth. So it's kind of almost matched that growth on a one-for-one rate. But Chinese is totally different. I mean, the debt growth has way exceeded the growth rate. Even though China's been growing very, very, very fast, I mean, the debt loads are getting enormous. The thing to notice here, 2008 time frame, I mean, they basically were like, hey, no financial crisis, no great recession. We're just going to accelerate the debt markets and basically drive the economy forward no matter what. And it hasn't looked back. I mean, look at the slopes of these curves. The yellow line for China versus the U.S. and Europe and everything else. I mean, it's a whole different slope rate. And the problem is when the slope rate increases and shoots past the U.S. and the European Union, potentially what happens is it ever slow down and come back to normal and basically match the growth rate of Chinese overall market, or is potentially we have like a crash, almost like 2008 style for China. That's the big fear we have right now, almost like a soft landing for the Chinese real estate and the overall Chinese debt markets. So now the question is, how does this crash happen, or how does this basic correction happen? There's really two different scenarios. Option A is a financing side. Let's say you're a home builder or a luxury condo builder. If you cannot get financing, whether it's debt or yuan based financing, now obviously you can't build new homes. You can't expand your actual asset inventory base. Option B though is also looking at home sales. So let's say, hey, the price is too high. All of a sudden you can't sell. So basically you built this beautiful building. You cannot sell those either pre-sales or post-sales after it's completed, that building right there. And all of a sudden you have basically a cash gap or cash shortage at that point too. Also that leads to a correction as well too, or possibly even default if you're too over levered as a builder itself. But that's one of the things that's really the big fears. But looking at this article right here, this is from Bloomberg. So it's basically looking at the overall Chinese property industry, like they're basically like the credit stress they have right now. Like I just mentioned here, it's what you're having right now is plunging home sales. So basically, the actual buyers are disappearing. The prices are too high. They don't have the credit. They don't have the financing on hand for consumers to actually buy some of these homes at the current valuations. And then what it's creating basically is a credit crunch, where all of a sudden these companies are building and building and building, which is very cash intensive to build all these high rises and apartments and everything else too. If they can't get that cash return in a reasonable timeline, they're going to have a credit problem. On the flip side, though, too, you also have potentially looking at bond investments, so U.S. and yuan-based bonds. If they can't raise cash because they're too levered up as a company, potentially they can't build new properties, or potentially finished properties they actually already have work started already. So that's what the crunch they're facing right now. And the big question is, hey, what is the Chinese government going to do with this credit crunch? Are they going to actually bail them out? They're going to actually let them default potentially? And that's the big question we have right now. So this is an article from 3 months ago looking at Chinese debt markets. And basically, this is from Fitch, which is a rating agency. It's saying, hey, even if home sales drop by roughly 30% potentially, I mean, it could be a massive cash crunch. And the problem is, right now, there's been so much growth. We're all of a sudden it's flatlines now. And those new home sales are dropping off like flies. What I was just saying right here, really big bullet right here is the second bullet down below. Basically saying in a severe scenario where home sales drop by 30%, 12 or roughly a third of its 40 rated developers could go cash negative, basically. And the problem is cash negative, you think, hey, short-term fine, you can raise debt, raise financing. The problem is, though, if that financing and debt's not available or not available at a reasonable yield, then you could be out of luck right there at that point. And the business as a whole could cease to operate. You got to remember, too, the most important caveat to remember this is roughly 20% of Chinese GDP is real estate based there, too. So even having a small percentage of that, potentially entire GDP fall, it could be a massive number. And right now, we're projecting, hey, 4.5 to 5.5% roughly year over year of GDP growth for China. If the real estate economy implodes, that might be like 2% or 3%, which for Chinese economy, it's just not, it's really unheard of. And the question is what's going to happen next. It could lead to a severe recession in the Chinese market in particular. So it's another article from Moody's, basically another rating or auditing agency. They're downgrading property developer Shimao basically as their debt troubles drag on. Just like I talked about earlier, it's basically having a cash crunch where they can't raise new financing. They're already over levered. They're not being able to sell the properties they have on hand or finish properties they already have on hand due to lack of cash. So it's almost like this negative feedback loop where all of a sudden they can't basically continue as a business right now. And basically what Moody's is saying is, hey, this company is more likely going to default in some aspect. Especially if they have foreign-based investments, they're going to default in those U.S.-based investment or U.S. dollar-based investments first before they default on the U.S. Chinese yuan-based investments. But it's going to happen. This is one of those things we're seeing. We're basically seeing kind of like the fluff and the fluff of the market right now. It's going to come loose, and all of a sudden these developers have been making millions and billions across the board over the last decade plus. It's all of a sudden the tide's going out, and they're going to be exposed when it goes out, and it's happening right now in slow motion. The Chinese government knows this. They're going to try to save the overall property market though, but there's going to be a correction. The question is it a correction, like a small tick downturn, or is it a full blown crash where all of a sudden the entire property basic market blows up and it hurts the Chinese overall GDP? So it's an article from literally 2 weeks ago. This is from the Wall Street Journal. It's basically Chinese property developers are broken promises, erode investor confidence. Just like I said earlier, a lot of this investment, it's foreign-based, U.S.-based investment dollars flowing in China. Because China has a high-growth market. They want those high-yield bonds. All of a sudden, the market looks pretty unattractive, and all of a sudden, those bond yields go absolutely through the roof. So you scroll down here. So you see really the bond yields for high-yield bonds. The blue line down here is basic global high-yield bonds. Roughly 5.8% kind of in the last month or so. Chinese bonds are at 25, almost 30%. They're pushing it up higher though too. But you really seen since last fall. It's been on up into the right kind of motion right there, which is really scary. At these bond yield prices, basically shows, hey, the default risk it's almost going to happen. The bond yield prices are so high where it's, hey, no one wants to touch it. They know this is kind of a house of cards right now. It's going to default more than likely if you invest your money in Chinese high yields bonds that are basically based on property. But yeah, I just want to show you guys that way you kind of get a perspective of hey, this market is not a normal market. It's not like a risky market. This is almost an absurd level of risk for any investor. And that right there is the Chinese real estate bubble and Chinese real estate debt bubble. I'm definitely keeping an eye on this in the next few months, kind of see what's going on with the actual numbers behind the scenes. Definitely see the Chinese reaction or Chinese government's reaction to this overall bubble. If you like the video overall, definitely hit the like button down below. Obviously, subscribe down below to the overall channel. We're covering everything from stocks to Ukraine crisis to just the overall macroeconomics. But yeah, it's definitely an interesting topic. I think will top of mind for a lot of investors in the next 3 to 6 months.